With the outcome of the election still undecided, despite the lingering uncertainty, the market appears to be taking a sigh of relief that there will remain a balance of power in Congress, limiting fringe agendas. With the Senate presumably controlled by the GOP and the Democrats retaining power in the House, the prospects of violent tax increases, the Green New Deal, or sweeping regulatory changes all appear to be off the table, at least for now. In fact, gridlock appears to be the most likely agenda scenario in the near term, a welcomed prospect for investors. At the same time, without a blue wave or even a presumed referendum on the Trump administration, there appears to be less of an appetite for additional massive spending, although both sides of the aisle have voiced support for further relief, given the ongoing pain felt by both businesses and individual households. That being said, a fifth-round aid package is still very probable at some point this year or early in the first quarter, but will likely be smaller in size than what Democrats would prefer or would have otherwise passed in the event of a left-leaning Congress. Meanwhile, broadly speaking, the U.S. economy continues to improve from the low lows of the second quarter, with activity and employment continuing to recover, although both remain well below their levels at the beginning of the year. The latest October employment report showed further progress in terms of putting more and more Americans back to work, marking the sixth consecutive month of positive job creation. But while more than half of the near 20 million jobs lost since the start of the pandemic have already been recaptured or recreated, a resurgence of the virus as we head into the winter cold could slow further progress in the labor market or even reverse progress already made should a rising caseload lead to further restrictions or a second-round lockdown causing additional hardship for businesses and employees. From here, the path of recovery, as the Fed noted in its latest November statement earlier this week, will depend on the course of the virus, as the virus and the policies aimed at stemming the spread of COVID-19 will expectedly continue to weigh on every aspect of the economy, posing considerable risks to the economic outlook. With an ongoing focus on the virus, the FOMC opted to leave the federal funds rate unchanged at a zero lower bound and monthly bond purchases at $120 billion a month in this week's policy decision. But while the committee did not make any adjustment to rates or the slew of policy initiatives already in play, the Fed continued to voice an intention to remain accommodative for as long as needed, as well as a willingness to add additional support should risks emerge. Bottom line, despite further signs of improvement in the U.S. jobs market, while the infighting continues in Washington, the onus now falls on the Fed to provide much-needed calm and implied support to the market. The committee is standing ready to offer any additional monies or credit needed to keep markets functioning smoothly and the economy on a path towards recovery, reminding market participants that there are still a number of tools available for use in the central bank's tool belt.